Thank you, Marty, for the wonderful investment content. And I am so happy to introduce the esteemed panelists for the private equity panel. Carol Pepper is joining us from New York. She is CEO of Pepper International Family Office Consulting Group. Then we have Russell Deakin here. He's the CIO and managing partner of Aceana Group. And I said that right, correct? Yay! Okay, Ron Divari, Executive Chairman, Chief Investment Officer, and co-founder of NewOak, is joining us remotely from COP28 in Dubai. Hello. And then Taylor West with Markham Accountants and Advisors is zooming in from Houston. Correct.
Hello.
Okay. An awesome panel from literally different continents. Okay. I would love for each of you to give a very brief introduction. Let's start by introducing yourselves. Go ahead, Carol, you start.
Okay, great. Hi, everybody. My name is Carol Pepper. I'm the CEO and founder of Pepper International. And for the last 22 years, I have set up family offices all over the world and acted as an external chief investment officer to several very large single family offices globally. I speak once a month on Bloomberg Television on the Daybreak Asia show and do a lot of lecturing. And it's a great pleasure to be with everybody here today.
Thank you, Carol. Thank you so much. Okay, let's go to you.
Sorry, Carol, we can't see you in person here. We could catch up. It's nice to see some old friends on the panel.
Yeah.
And, it's a pleasure to be here. I'm Russell Deakin. I'm the founder of a single family office, Aceana Group. Just a little bit of background about our family. We're a British Brazilian family. We have focused on operating businesses, real estate development, as well as productive farmland, rice, and cattle in Brazil. And I've actually been a partner from many years ago, Latin America's oldest private equity venture capital firm in 2001. And since 2006, I've been investing in private equity from a family basis, on an individual basis for the family.
Wonderful. Okay, Ron, please.
Hi, my name is Ron Divari. I'm the founder and CEO of NewOak Capital. NewOak Capital is a private debt, private equity, and also advisory and asset manager. Our focus is primarily on what I consider things that we originate from cradle to grave. Startup on the tech side and the project finance on being able to put money in things that are much larger scale and with stable revenues over time.
Okay, thank you so much. Okay, Taylor. Taylor?
Yes, hello, can you hear me? My name is Taylor West. I'm a partner here at Markham. Markham is a large accounting firm with audit, tax, and advisory services. I manage the firm's valuation business for the whole firm, but I sit here in Houston. And we have a practice of about 150 valuation professionals that provide corporate valuation advisory services. We value a lot of private equity investments for many different reasons, as well as perform valuations for high net worth individuals who are doing tax planning and so forth. Pleasure being here today and happy to participate in this discussion.
Wonderful. So Carol, I would love to start by asking you, what is the outlook for the private equity markets in 2024, it being the election year?
Well, I would think that next year should be a better year for private equity. Obviously, this year there was a lot of uncertainty. A lot of people had a hard time raising funds. Many people I know did not get their raises done. Combination of the high interest rates, which make all the models harder to work, and just general investor uncertainty about what is happening. So I would think that next year The markets will be more favorable, hopefully. The interest rates will either stay the same or hopefully go down a bit. And this will increase investor confidence. I think, we've had a nice rally in the public equity markets this month. So I'm hoping that next year, as an election year, generally it's more benign, and we will be able to get a little bit more interest going into the private equity market. The question will partly be, what format do people want to invest in? They want to invest via funds, via direct deals, via co-invest, or should people that are looking to raise money offer multiple options? Because not one size fits all with the way investors are going these days.
Carol, let's pursue this line of inquiry, actually. What do you think? Are families still interested in funds? Are they more focused on direct deals these days? How can funds justify the fees? What are your thoughts on that?
Yeah, I mean, I'm finding people, frankly, a bit more interested, unless it's something very specialized, a bit more interested in direct deals, because then they can feel like they have more sense of control. Potentially, if they can go in as a co-invest, they're avoiding the GPLP fee splits. So those who are larger, the family offices that are larger, do like the large deals. But if you're talking about a small family foundation, it's not practical. You still need funds for certain types of investments, and then institutions need funds. And some very large trusts with a lot of trustees are more comfortable with funds than direct deals. So it really depends on who your target audience is as a fundraiser, where you're going to find interest. But I think everybody's very, very, if you just say I'm another middle market buyout guy, people are not all that excited. You have to have a thesis that's sharp. It has to make sense for today. Obviously, if it has some AI included, people get more excited, or deep tech, or, some sort of healthcare thing going on. That tends to be more interesting. And I think real estate will have a little bit of a comeback, hopefully, because again, the interest rates are lower. So hopefully we can get the market moving a bit again.
Wonderful. Thank you so much, Carol. Russell, speaking of, what are family offices interested in investing in? What is your perspective on that?
So I just want to compliment a little bit what Carol said. There's a saying of, one family office, one family office. And I think that's very true. So from our point of view, we have, in essence, two homes, although I'm a long lost Brit, I now consider Brazil and the US my homes. So when we're in our local countries, we do direct deals, we do co-investments, and we even do funds. But if you're going to go further abroad, and I think there's opportunities, for example, we have exposure from the legacy, we have exposure in Latin America, we have a lot of exposure in the US, we have exposure in the UK, we have exposure in Singapore, we have exposure in India. So when you're going to new fields, the first time when I invested, for example, in the US for our family, it was 2006. And I think what's quite typical, we started with a fund of fund, then we went into funds, then we do directs, co-investments, and you go down the verticals, and you go down the channels, and we've done that. And so we've made a decision, for example, there's certain verticals that we prefer. We've done a lot of tech investing. So we've done deep tech, we've done blockchain, we've done AI, we've done fintech, we've done life science, med tech, space tech, digital health, life sciences. Those are all verticals that we believe in the trends. And then it's finding the managers that have experience and are able to do deals. But then we've also, on those that we feel more comfortable, we started doing co-investments and direct. So it's a process. And I think if you do a methodical process along different verticals, and in our case, different geographical areas, you start broader, you start with diversity for fund of funds, you learn the business, you learn the country, you learn the verticals, and then you can go further and more detailed. And that's how we've built out our private equity fund over the last 20 years or so.
So it's a process.
It's a process.
Taylor, what do you see on the valuations end?
Right. In terms of what more specifically are you talking about, the current environment or?
Yeah, the current environment, because your firm does valuations for private equity funds.
Right, absolutely. Yeah, so, obviously we've seen what everybody else is seeing with the I guess, a slowdown in transaction volume this year. We watched, how interest rates impacted valuations starting last year. And you had the immediate impact on required rates of return and how that flowed into discount rates and push values down. And then we have, these secondary impacts that come along with the kind of the economics of the higher cost of capital and leverage deals, transaction volumes coming down, in relation to that. And then, some buyer hesitancy and seller hesitancy on not wanting to sell into a down market. So all those things kind of played together over the past year or so to what we've seen values come down in many areas with just a few bright spots. And then so there's also the broader economic impact of the rising interest rate environment that we've watched, kind of come off now, just over the last quarter or so, as inflation is tamed and economic growth has been surprisingly resilient in this environment. And then I think there's also, with a lot of capital still there and available to invest, we started to see some significant increase in inquiries in our transaction advisory side of our business, with a lot of people wanting to put money to work before year end. So we've seen kind of an influx of work related to transactions just recently. So with that, I think the valuations are still being impacted with what we saw over the past year, but we're hoping that maybe we've found, an inflection point where things are going to start coming back. I saw an article come out yesterday talking about, potential rate decreases this coming year, maybe toward the latter end of this year. And it'll be interesting to see how the market digests that and whether that starts to show up in discount rates and expected inflation rates and things like that. So.
Thank you. Ron, you are in Dubai. You're at COP28. What are you seeing? What are some of the interesting things that you can share with us?
Sure, I think I pretty much agree with the panel, what has been said. Yet I think, it's going to be very sector specific. As pointed out, I'm actually speaking here, coming from Dubai in COP28. I think and also we attended and participated in the New York Climate Week. I think we see a lot of excitement about, essentially renewable sustainability, and a lot of it is obviously driven by the acceleration in terms of regulation and acceleration by the fact that there will be tax, there will be not just reporting requirements, there will be the big firms that are going to have to pretty much consider both measure, report, and validate their greenhouse gas emission. And so as a result, we're seeing a large number of initiatives addressing that, technology needs, as well as getting ready. Second is we're seeing a huge amount. I think there's a lot of excitement about AI, but on the other side, the banks are extremely nervous about the AI being able to essentially validate and be able to meet AI model requirements. We are seeing a huge amount of inquiries by the regulators to kind of figure out what institutions are doing, how they're using these models. In the US, that hasn't really yet been formalized, but in Europe has taken some initiatives about effectively model governance. So these create, a huge amount of what I consider additional pileup in terms of how larger corporations had to be more responsive to these new requirements, so that essentially we think the demand automatically has started shifting supply and focus. We ourselves, for example, had launched a product called Risk AI, which is very focused on GRC, governance, risk, and compliance, know your technology. And so anyways, I think we're finding that, there's a big focus on Africa and some funds that will definitely flow there in order to be able to offset the carbon emission in the more developed countries. So I think from where I stand right now, I don't see people getting worried. As a matter of fact, I see people are super excited about the challenges ahead and the opportunities to solve those challenges. So I'll come from, glass half rather than empty. And, we have always focused on what we know and what we look at. And I think in my entire career, I have not been as excited as I am today about the opportunities that are ahead of us and be able to deliver some very unique enterprise solutions to be able to address some things that are less agile larger corporations will end up having to see you're going to see corporate strategic investments, which is really another set of, we're focused a lot on family office institutions, but corporations themselves are, they don't want to be left out of these sectors. So they're looking very, very actively in these areas. So from that angle, I see, a lot of interest.
Wonderful. Well, Ron, since you mentioned opportunity, Carol, where do you see the opportunity in private equity?
Well, I think, certainly as Ron has just told us, this whole climate transition and the reporting, particularly reporting being required starting this very year in Europe, that the carbon border adjustment tax is going to drive a lot of companies that are supplying goods and services into Europe to have to start doing their net zero measurement and then offsetting where they cannot improve their operations. So any company that's involved in that sector has good opportunities. And indeed, that's an area, certainly carbon sequestration or carbon mitigation has been an area that even this year in 23, still had investor interest and still was getting funded, because even though here it's back of the burner and the rest of the world is front of the burner. In fact, Ron, Aldar, if you want to see a phenomenal net zero report, look on Aldar's. Aldar is the largest building company in Abu Dhabi, and they have a very impressive net zero plan to read about. And I'm sure they have a big booth at COP28. I wish I were there.
Yeah, actually, I've never seen so much initiative announced, including we are getting involved with Great Green Wall of Africa, which is really a UN initiative to
I'd just like to add something that perhaps
Somebody needs to mute. We can't hear Ron. Somebody should be muting who has background noise.
So I think, as I think it was fully highlighted, these challenges are massive. And I think Al Gore took a very, very big hammer today in his speech, if you have watched Bloomberg, and I thought maybe even his life may be under danger getting out of the region. He literally said, the biggest impediment to sustainability not being far ahead of here, and carbon usage going up is due to the fact that the oil producing nations have not done enough. And I think that pressure will continue. And that will push them to, I think that this convention here in UAE itself is a good presence, is that they're not going to be able to hide any.
Mhm.
Thank you, Ron. Thank you so much. Russell, where do you see opportunity?
So I think we've talked a lot about perhaps bigger trends, and certainly these trends are important. But I want to just throw something that perhaps not everyone's looking at, and looking at the valuations is very important right now. And it was interesting, yesterday we had a very interesting speaker, Tim Draper. And Tim obviously has a lot of experience in venture capital, goes back a couple of generations with his grandfather. But he and I had a nice conversation, and I agree with him that going forward in this environment, given the valuations and the change in valuations that we've seen, especially on the venture capital side, the next couple of years are actually going to be a very good valuation opportunities for seed rounds and early rounds. Because if you look at the cycle of private equity, you look at the cycle of venture capital, it is very much so where the confidence falls out, they are very much reduced valuations. And if you look over the last 30, 40 years, many of the most profitable companies, the unicorn companies, come out of the ashes, as it were, come out of when we think that the confidence is very low. And we're actually seeing that. What we've done over the last 4 or 5 years, and it has accelerated this space. Just to give you a couple data points, Uber went public at $63 billion. Some people may remember that Google went public at only $300 million. So companies are staying private much longer. There's much less valuation created after they're going public, where they're getting closer to the IPOs or larger private equity deals. We think that valuations and the value are very much focused in the next couple of years in the early rounds. We've seen that. If I look at my investment returns in direct investments as fund managers as well, they are smaller managers, actually managers $250, $300 million or less. These are 4 or 5, sometimes even a higher return, 5x. One's doing 10x. They have people with vertical experience, very experienced in the verticals, taking advantage of a very early stage investments. Obviously, it's a different risk reward, and I wouldn't recommend putting a tremendous amount. You gotta look at your portfolio construction, but that is something that we've seen over the last couple of years. And I think this valuation gap and the returns between later stage and early stage have increased given the environment that we're in at the moment. And we continue to do this not only domestically, but also internationally as well.
So what do you like? What are the sectors that you like, or what do you think the opportunity is going to lie in 2024?
Well, some of them are sectors that we've talked about, for example, and then it's, whether it's FOMO, fear of missing out, or FUD, right? We have to evaluate, but we found, for example, an AI manager. AI is now the rage, but AI has been going on, machine learning, you've got it for 40 years. So we don't invest in a new fund of guys who just come out of business school and working for a big Wall Street firm. We found a manager that's been doing this 7 or 8 years, put on a worldwide seminar, and is a thought leader. We look for thought leaders with vertical expertise. So AI is one. Deep tech is also, I think all of these, you're seeing the intersection of a lot of these technologies. And soon, if you're looking at companies, if they sell to enterprise, the chief investment officers of large companies don't really care if it's deep tech, blockchain, AI. If you bring them a solution that's cheaper, faster, more efficient, that's what they want. So if you look at companies that focus on providing real solutions, and also with clients that will pay them money rather than stock or other options, that is something that will continue. And what we found is those type of companies that can be in different sectors. As I said, we've done AI, we've done deep tech, we've done blockchain 5 or 6 years ago. We've also there's medical, there's life science, there's digital health. All of these trends are fairly easy, I think, to find. So significant ways, renewable energy, as I mentioned. The key is to find managers that have the expertise. The key is to find people who can execute on the portfolio companies. And then the key is to find valuations that make sense. because of many companies conceptually they're good, but they can be very, very expensive. So what we found, we've gone back to certain portfolio companies and we were able to renegotiate 50–60% cheaper than perhaps around a couple of years ago. So you take a reset. Are these companies worthwhile going forward, given the valuation? So there's a lot of opportunities, and I think as more and more people get a bit more fearful about the economic environment we're debating, whether there's going to be recession or not in 2024. We've been doing private equity for over 20 years. I think if you have to continue to invest, and then you, on the tail of your portfolio company, you can accelerate or decelerate depending, but you have to continuously invest and divest and build up a portfolio over time and concentrate on those sectors, verticals that you feel most comfortable and understand the most. And certain family offices are very good at doing certain sectors, others are not. There's a few sectors I don't feel comfortable with because I don't have the experience. The ones I mentioned are the ones that we've been doing, and we've been investing in technology for over 20 years. There's other families that can do food and beverage, retail. There are excellent opportunities in those, but I, as a family office, don't have that expertise to do those. So we like to focus on what we know well, and then learn with other managers and do co-investments with them. I think that's a very, very important aspect of family offices. Before you just do the directs, learn from the fund managers, learn from it. We had one fund manager, he lent me 2 PhDs to look at a digital health deal for 1 month. That's a real partnership with the fund manager. I leaned on his expertise in the fund, and then we made and that was a deal that he wasn't directly involved in either, just to put that in context. So I think when you look for fund managers, you look to create real partnerships, not just give them money and then there's no interaction. That's very important. So as we go further along, it's really about the chemistry, and spend a lot of time looking at those due diligence soft issues, because this is a long-term partnership, 10, sometimes 15 years, maybe 7 years, and it's not just the money. And they can teach you, and you can teach them, and the complement on skill sets is very important, I think, to find good opportunities.
Wonderful, thank you. Taylor, a question for you. We saw that private equity reduced capital flows into the energy space, and that's been going on for quite a few, for several years now. What are you seeing now, and what do you think is driving the trend?
Sure, yeah, of course. So after having basically 3 industry downturns, and from 2009 to 2014, then again with COVID, all within 10 or 15 years, there were financial performance issues in the energy space, and then in addition to that, during that time frame, you had kind of growing, we'll call it social headwinds, and with all of that, and with the COVID collapse in oil prices, we saw private equity significantly reduce its exposure to that space. So, over the last few years, the industry kind of reoriented itself toward, financial performance, living within cash flow. So instead of focusing on growing reserves and resources, it would focus on actually generating positive cash flow instead of reinvesting everything and distributing cash flow. So you saw a change in the financial focus of these firms. And at the same time, you saw an ESG focus. Both companies and their investors were focusing on investing in ESG, basically cleaning it up. And so during the last several years, while private equity had kind of pulled back from the industry, the industry kind of evolved into where now you have traditional energy companies making significant investments in the energy transition. You have private equity firms that were focused on traditional energy investments now investing in the energy transition. So with all that, just and also the last couple of years of more stable, higher oil commodity prices and the ability to actually make positive cash flow, the industry has started to attract over the past year or so we're seeing private equity come back in a more meaningful way. So with that, you know, we've also seen some IPOs. We saw this year, we saw 2 upstream MLP IPOs, which we hadn't seen an upstream oil and gas MLP in many years. So it seems like things, you know, after a couple of years of healthy pricing and a reorientation of the focus of the industry, things are starting to look up. And that's, I think, further going to be bolstered by the Inflation Reduction Act and all of the incentives around the energy transition. And with the more traditional players investing in that alongside their traditional energy assets, we expect that the business to continue to gain health.
Thank you. Carol, I wanted to ask you, with 2023 being such a difficult year for fundraisers, what are some of the lessons learned that you can share with us? What do we know in December of 2023 that we didn't know maybe 12 months ago?
Well, first, I'd just like to make another comment about what Taylor just said, which is there's an aspect in the oil and gas field that is very attractive for ESG investors right now, and that is there's an ability to cap, finally, all over the world, these old abandoned oil wells that are leaking methane. In fact, there was a huge article in the paper yesterday talking about, I believe it was the Times, but it could have been the Journal, talking about, you know, the large oil companies being forced to sign pledges that they would clean up the methane leaking in their fields, because that's much more dangerous than carbon. Carbon is actually the leaking of methane, much more damaging to the atmosphere. But there's also an opportunity for people that, family offices that own their own oil fields that had either shut-in wells or old, very dribbly wells that aren't doing much, actually earn carbon credits by capping those wells. So if anybody's interested in that, that's what I've been working on, that I'd be happy to discuss at another time. But that's an example of where you have ESG and oil and gas joining hands, if you will, to work together to fix some things. And then in terms of what did we learn this year? I mean, I think for people that were trying to raise money, it was sort of a heartbreaking year because you couldn't get a date basically because of just general investor weariness and leeriness of the markets. Not knowing what's going to happen is just really difficult for everybody. So I would say, you know, you have to have a lot of staying power to continue to wait for the right moment that certainly family offices are going to invest. You know, family offices, for all they say otherwise, really do want to make money. Even more than institutions might say, well, I need an asset something in my asset allocation to diversify my holdings, or potentially at certain points we'll have a different return profile. But most family offices want to see very clear visibility of how they're going to earn a return. As Taylor mentioned, you know, oil and gas learned that lesson, and now I think the rest of the private equity market is learning that you really have to have a strong thesis. It's extremely sharp. You have to have experienced people, just not kids out of school, and you have to have ideally clients on the other end ready to buy whatever this product is. So if you have those things, you're much more attractive. So the days of people just sort of throwing money because it's going to make money, I think are long gone. I don't see those coming back right away, if ever.
Yeah, it's like a return to fundamentals, right? Because that's exactly what you were talking about earlier. All right.
Yep.
I want to ask all of you, looking outside of the United States, right, internationally, where do you see some of the most interesting opportunities? Ron, let's go to you. Ron, we can't hear you.
Yep.
So again, I highlighted, you know, my personal view is that, at least for our own portfolio, we are finding that solutions that we perfected in the US and North America have a huge amount of applications in the Middle East, Africa, and Southeast Asia. So on the earned wage access, on cardless, essentially digital card, on risk AI being used as ability to know your technology, know your models. All of these for us have been extremely we're seeing a lot of good audience. As a matter of fact, I'm flying to Jordan of all places, and on Wednesday morning to discuss primarily, the application of these proven areas. So we do feel, again, sustainability is we're just at the very, very beginning of that wave. And as the regulatory pressure is coming down pretty hard, and that will continue to grow, and people would want to grow that. And I agree with Carol that money saved is money earned. So we have learned ourselves in 2023 that we could live with probably half of what we were spending, and still even make better progress and better, cut the fat. So I think that will continue, I think, be the norm. And I also wanted to highlight, we launched a new program in what we call secondary, and it's not quite secondary, it's actually continuation funds, which we have created a vehicle where we can actually offer those continuation funds at a very cost-effective way. And that, I think you should be looking at it, because as funds come to their maturity, those assets need to be recapitalized. And given that many people are not currently sellers, those single fund or single company funds should be a good investment, even though you may not have the due diligence skills. Those are highly diligenced by many parties and valued properly, and gone through, essentially very rigorous disclosures, and the state is very different than just buying a secondary. So we highlight, if you have any questions on that, that's something that, we normally don't start a new product at a point like this, but we saw that very compelling when there is a pretty sizable amount of these. And these are, large investments. There would be, tens of billions, but we get a $100 or $200 million access to it. That is very attractive to the family offices, because then they can tag along without being part of the capital structure.
Thank you so much, Ron. Russell, where do you like to invest internationally? What do you look at?
So I can give you two examples, specific examples that we've done recently. In 2019, we took a trip to India, and at that time decided there wasn't enough distribution, the valuations were like the DPI wasn't there. But now I just came back from a private equity conference in Zurich. Last year, global LPs had 58% said that China was their first choice, and this year it's down to 3%. We think there's a lot of money going into India because of that. We have chosen one of the largest, not the largest, the oldest Indian fund manager, most successful in terms of exits and IPOs. And we've decided it's a very good platform, and we think for the emerging market, India is going to be doing well, and there's going to be money coming in, which is going to lead to trade sales, which is going to lead to distributions and getting the DPI up. So we chose, after 4 years, an Indian manager, and I'm happy to share with other family offices that information. The other thing we did recently, we've been taking a few GP stakes. So I did my first investment in over 10 years as an LP back into Brazil. We invested in a fund manager that is focused on doing logistical distribution centers. And the reason we did that is the following. Brazil is more or less the size of the continental United States, 220 million versus 330 million. If you take all the square footage of logistical warehouses in Brazil, it's less than what you have in Chicago. Think about that. We think that's an excellent opportunity. So we're investing in that as well. So there's two examples, one in India, one in Brazil, that we've done in the last 12 months.
Wonderful, thank you. All right, well, I would like to ask for your closing statements, anything else that that I haven't asked you, that you really wanted to be asked or you'd like to add. But before we do that, should we see if there are any questions from the audience? So maybe give them an opportunity to ask you anything before we go to closing statements? Yeah, sir.
To ask the gentleman from Markham, where are we in the stage of markdowns of private equity, of all private equity?
Great question.
Everyone in the room is saying how great it's gonna be next year because private equity is gonna get marked down, but how far are we on that cycle? I'm on the pre-investment committees. We see very little markdowns. We've seen a couple bankruptcies of equity deals like Smile Track. We haven't seen much markdowns because people are creative in their ability to defer markdowns by various tricks that various people are creating. I'm not just talking about that.
Taylor, the question is for you. How far down the rabbit hole are we in terms of valuations?
Yeah, I was trying to, it was a little difficult to hear. So was the question where we are in terms of the markdowns?
Yeah.
Are we
Yeah.
toward the end or the beginning?
Are we toward the end are
Is
we
that-
toward the beginning, middle, or end of taking markdowns?
It's hard to tell. I think if there are games being played, that you can only cover things up for so long. So if there are true issues there and somebody's not marking down yet, you know, if that's the case, then I would expect to see that present itself. I haven't personally witnessed that going on. I think you know, with where we are in the economic cycle, with the economic data that's coming in and the outlook for potential rate decreases this year, I mean, maybe we're somewhere in the middle, maybe past the middle of the cycle in terms of write-downs. But it's, you know, it's just very, very difficult to tell.
Is there an industry accepted methodology of revaluing private equity? I mean, if you're a $2 billion company and you do a $12 billion round, is that a valid basis to mark down? Those are the games I'm talking about. We're not seeing that.
I see what you're saying. So if they do a down round, but it's small and they're not marking down to it.
Well, what do they call it? Gap financing? Is that what the word, the phrase is these days? So it's an unpriced gap financing, maybe sometimes they do that?
Yeah, they do a non-price deal,
Right.
so that, which is based on the discount.
Right, it floats to the future value, right?
It's not a down round.
That's extremely common right now.
Right.
Bridge financing or bridge waves.
It's one of several flavors.
Right. I think that's where, you know, the information rights are key. So you can see, you know, the true performance of the business. You know, obviously when you're doing something like that, you're trying to avoid a down round, right? So to really get to what the true value is, you'd have to have access to the underlying data to figure that out. So I'm hoping that's somewhat helpful, but it's just hard to tell and very specific.
So are you saying that the fundamental valuation is, if you look at it from essentially fair value or derived value, are you considering valuations to be essentially near fair, or do you consider them there's still maybe a little bit of a hype in them?
For the valuations that we've been doing, we've been, you know, maintaining consistent methodology. To the extent the performance of the businesses have been impacted by the economy, or there's expectation of an impact, that shows up in the valuation. Also, the impacts on cost of capital from the prevailing economic environment impacts the valuation. So for the valuations that we're doing, I would say that they're, you know, that they're kind of following in step with where we are economically.
Thank you. There's a question.
Yeah. Russell, in terms of the United States, what due diligence in the last year or so have you done that could help us in terms of doing better work in the due diligence arena, in terms of a question you might ask, or a tactic you might use to get better data or information, so you're not surprised 6 to 12 months later by what you didn't ask and didn't see?
So I actually think that as I get a bit more experience, a bit older in doing this, is perhaps something that maybe not be so obvious, but it's more the soft data and analyzing the character. I was talking to a fellow family office last night, and we joked that a bad person or bad character, no matter what's written in the contract, will find a way to screw you. And a good person, despite what's written in the contract, will try and make you whole if he's thinking about a long-term situation. So actually, because I first started doing venture capital and private equity in Brazil, where the legal system is bureaucratic, and we could argue that it's complicated in other ways as well, it really helped me to spend more time in doing the due diligence and asking for references that may not have been references that the fund manager gave me or the CEO of a portfolio company, but using your network and finding and doing other reference checks. So I've spent, so certainly sometimes it's hard to find information on the financial data for smaller companies. So it really is about the character of the people and who can execute. And I think as I've seen the investments and the process that we've done well, and perhaps we could improve, it's been much more about spending the time talking to other reference checks, other people, to find out with whom we're going to create a long-term partnership with. And that's avoided the big blow-ups. The financial changes and stuff can happen, that's business, but you don't want the donut, you don't want the scandal, you don't want the illicit, the illegal situations. And I think that is something that we've gotten better with over time in the US.
And Marty, just a second, there's a question from there.
Yes, so from my experience, VCs, it's kind of trend-based right now. We are
Can you speak up?
Yeah, they can't hear you, sorry.
Come a little closer, please.
From my experience, trend-based right now, we are in the AI kind of ecosystem. I wanted to know what the current appetite is for the fintech and proptech early stage startup in the VC ecosystem.
Well, there's a VC panel next. But
Oh,
if you want to talk about the appetite for AI and VC, AI and
I mean,
proptech.
if you ask a
Go ahead,
question
yeah,
about
yeah.
PropTech, I can answer that. We did, for example, it's all very specific. It all depends very much so on the actual, whether it's in private equity, whether it's in venture capital, whether it's growth capital. It all very much depends on the opportunity of the company. I think we just did an investment in PropTech, for example, a real estate PropTech property manager. They has it's growth capital. They have a ARR of $50 million. Post-money valuation is only $80 million. So 1.6 times. If you look at some of the other property management in the public sector, there's 6 to 8 times the Yardis of the world. This is growing much more. So there are opportunities in terms of if people if you feel comfortable with those different areas, then you just dig in terms of finding for those opportunities. That was an example where we put in, we've now put in over $3 million. We put in an initial check a year and a half ago. We like the company's growing 70% organically. We think it's going to be hopefully in 3 years a 3 or 4x return. So that's a nice return. But we took advantage of this. They wanted a bridge round. We believed in the company. We were very aggressive on our terms. We got a 60% price change. But in that case, it was a positive because the company's at EBITDA was doing well, was making money. And I think we took advantage of the long-term prospect to have a longer-term return. We sat down with the management team. They agreed with us. They were willing to sacrifice a bit for the short term to have a much longer-term upside. So sometimes down rounds could be a positive thing for a good, well-managed company. And that was an example. We were delighted to do a down round with them. we were surprised they accepted it, to be honest, because they keep growing 50-70% a year, and they're able to break even, but they realized we could help them get even further and do an IPO in 3 years. So sometimes the down round's a bad thing, sometimes it can be a good thing.
Ron is a fintech investor. Ron Javari?
Oh, yes. In terms of, AI, fintech, I think pre-revenue companies are having a hard time. Majority of people, whereas, when somebody would have done a lot of pro forma, they would like to see those companies to start making the revenue show the trend line to be able to invest. So I think that makes those companies, a very attractive place if you can validate their assumptions. So we are finding themselves, a company like us, that we're aggregating some of these into our platform and trying to create a bigger synergistic stuff.
Thank you, Ron. Yes.
So I have my question. So I think, any comment on AI, ChatGPT and due diligence in using it?
We actually, I have tried so far unsuccessfully, but I'm stubborn, so I think we're gonna get there. We've tried to use AI to help us with the investment memos, to do the 80-20 rule. So, spend 20% of the time on maybe 80% that counts. We haven't quite gotten there yet. We're actually trying to use, there's a couple of AIs using ChatGPT. There's another one called Claude and another one called Perplexity. So we're just trying to see which one, some of those hallucinate less than the others. I think if you ask me that in 6 months' time, we'll get there. At the moment, we haven't been able to use it specifically for hopefully having our team and the analysts do 80% of this and 80% of the time on the 20% that really matters. So far it hasn't worked, but it's so fast moving that I think that I'm confident we'll get to it in the end.
Maybe Carol has some perspective? Carol?
Yeah, well, I was just gonna go back to something that Russell said and Taylor said too. AI is the advent of more fraud, more scams, more fake photographs, more fake videos, more fake everything. So due diligence is going to become more and more important, but it also going really old school, literally getting on the phone and talking to a human being if you're checking references, and take advantage of a wonderful company I always promote, and that is Kroll, Kroll, the largest security firm in the world, and they will dig into backgrounds of these wonder kids to find out if they're really wonder kids or scam artists. I think there's a wonderful opportunity for scam artists here to, look at George, whatever his name was, the guy they just got rid of in Long Island. The fake backgrounds, the fake schools, the fake claims of fake achievements have to be gotten through, which is why a lot of us like to deal with people we've already known for 20 years. Russ, we've known each other a long time. We feel very comfortable that we trust the integrity of the other person. So I think that's one of the biggest challenges AI is going to bring to us as family offices and people representing family offices, is making sure that we get past the fake backgrounds, fake photos. I mean, you can Photoshop yourself into standing next to Al Gore, and who's going to be able to tell if that's real or not? So it's a more challenging time. I find it actually challenging, and I would never use AI to diligence anything. I mean,
Yeah,
if you
so I have a different opinion.
you can trust. Who's gone that far back.
So my opinion, and maybe Rick and Selma remember this guy. There's a guy, used to be like the family office, he did with this guy in Palm Beach, he's a professor. And his methodology for due diligence was looking at inconsistencies between documents and statements. And he said 80% of the time, you remember the guy, the black guy, professor?
The guy in FAU.
Yes. So why wouldn't you just take every document you ever get from anybody, go on their online social media and just feed it into ChatGPT in 20 minutes? And get every inconsistency, it'll tell you. Right, this guy said he went to that university in this state, and he went to that university at MBA, right? I mean, or
But you still, I mean, look at what's, I mean,
Everybody's
you
on
still have to
YouTube, get
physically
every
have it.
video they've ever done and catch, I mean, that would have broken Bernie Madoff. You could have, if he was on YouTube like crazy, you could have fed every video he ever did and get the inconsistencies. This guy's got a lot of inconsistencies, right?
No, 100%. Bernie Madoff passed rigorous operational due diligence by Fairfield Greenwich, Banco Santander. These are major institutions that spent a lot of money.
Rigorous at all.
Rigorous. I'm terribly sorry, but today,
Listen to Rick.
it is not part of due diligence. When doing due diligence on a manager, it is not part of due diligence to go to the
public records?
no, hold on a second, to where the shares are held. What's that called? Huh? The DTC. Even today, it is not part of the operational due diligence to go check and see if the manager is actually holding those shares.
I'm just saying that the school was there to do a background check.
Bernie Madoff rigged the system. He passed true and rigorous due diligence because he was such an incredible con man that he managed to get the SEC to just give him a pass and not dig in deep. But
He passed due diligence at that period.
But
He passed due
major
diligence at this period.
institutions, Banco Santander, did rigorous due diligence on him.
Right, you're missing the point.
I would actually say,
The point is, due diligence has changed.
Not much.
I would actually
Not
say.
sufficient.
So
Among these
this,
guys it has.
there's the formal due diligence, but what Carol and I mentioned is the informal due diligence,
Correct.
having many conversations with people you trust about people. And
Right.
that's something that I spend much more time every time between the managers, because that is why I didn't invest in Madoff, because he didn't pass that with me.
And I was at the Rockefeller family office when he came knocking, and we did not invest with him either. Because to me, he oozed snake oil, and when you asked him normal questions, he was offended. Like,
That's a big one.
That's a good one.
That's a big one.
yeah, he was quite offended if you challenged him. That's all, by the way, I would generally say, if you ask any manager or anybody looking for money questions and they're offended and get aggressive, that is your very first sign that they're absolutely a con artist. And I've uncovered multiple frauds over the last 22 years for my families, unfortunately, that they had already invested in, of hedge fund managers or fund-to-fund managers or this manager or that manager. So it's still going strong, but your best bet are groups like Kroll, and as Russell said, and I feel, having old timers that are friends of yours who can make phone calls if you're new to the game.
I think for real
Thank you
companies,
so much. Ron, closing statement, we're just taking the 30-second closing statements.
yeah, I want to just on the AI thing and make it my closing statement. We're just at the very, 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 very beginning of the AI wave. So the AI governance is almost none of us have any clue where that's going to take us, meaning that companies that may have clients may have already AI, they may find it potentially there's a huge amount of liability ahead. So just keep a watch on that and make sure that you invest along people who really not only looking at the upside, but also looking at the there are going to be very few companies that are going to be disciplined enough to create applications that are widely usable. And that's one area that I think I would highlight, don't go by the hype. You saw that at ChatGPT or that was just a simple board example where the two sides of the company could not agree on whether they should slow down or speed up. So that's where there's a lot of issues in that, and we're going to learn a lot. This is going to be much bigger than internet investing, which we didn't know anything about, and we started learning. So topic for future family office conversation.
Thank you, Ron. Taylor, very quick closing statement from you.
Yeah, no, it was a pleasure being here today. I'd love to hear from any of you if you have valuation related questions. You know, on the AI thing, Markham is looking at it. We're looking at it very seriously. And just one thing that I wanted to bring up is confidentiality of the information that you're feeding into it. If you are going to use it for anything that, involving your business, just make sure you understand where your information is going once you feed it into the Chat GPT or whatever platform you're using. That's something that's obviously very critical to maintaining the confidentiality of information that you have. But again, I'm happy to be here and happy to answer any questions. Feel free to contact me directly. We'll talk to you later.
Thank you, Taylor. That's a closing statement, please.
Certainly, I think we found our best deals looking, one, with small funds and doing co-investments with them. So we have very good success looking at niche fund managers, with a lot of experience.
I think they're all
I don't think
allergies. I had to get them replaced.
Maybe I'll just mention
Yeah,
it.
sure.
So we found a lot of good deals looking at small funds, niche players who've known the verticals for many, many years. And we've also found a lot of good deals talking with our fellow family offices. So use your networks and dig in. It takes a lot of time to find good deals and a good pipeline. The more you invest with this is why we keep going to conferences, like what Marty does, meeting other family offices. This is valuable. I've been doing it for over 20 years. I hope to be doing it for another 20 years. Thank you.